Welcome to this explainer. Today, we're going to dive deep into the fascinating mechanics of Islamic banking. We'll be exploring its incredibly pure ethical intentions, but also the fierce modern criticisms against it. So whether you're a finance nerd or just kind of curious about how ancient laws intersect with modern money, you are absolutely in the right place. Let's get into it.
Here's a quick look at our agenda for today. First, what is Islamic banking? Second, the mechanics of partnership. Third, the double deception critique. Fourth, the housing loan trap. And finally, redefining Riba today. All right, Section 1. What is Islamic banking? Let's lay the groundwork right off the bat and ask the most fundamental question. Why was a totally separate banking system created for Muslims in the first place?
Well, the entire catalyst for this alternative financial universe boils down to one word: riba. In Islam, charging a fixed extra amount on a loan, what we'd normally just call interest or usury, is strictly prohibited. You see, the core translation points to unjustified growth, basically making money simply because you already have money rather than from genuine trade or hard work. Because of that, there's a massive theoretical divide between the two systems. Think about a conventional bank. Their whole model is essentially borrowing money from depositors to lend it out to borrowers and then earning a profit on that interest spread. But Islamic banking? It proposes a completely different paradigm. It claims to make money not through interest, but through partnership, real trade, rent, and, this is key, genuinely sharing both the profits and the losses with the borrower. So how does that actually work? That brings us to Section 2, the mechanics of partnership. Let's look at how this profit and loss sharing model functions in theory, because on paper, it is an incredibly equitable system.
And this isn't some new age financial trend. The foundational principles date all the way back to the 7th century. The Prophet's first wife, Khadijah, was actually a highly successful trader who operated using these exact partnership principles. Then, throughout the Middle Ages, these standards spread across regions like Spain and the Baltic states, really heavily influencing global trade. Finally, around the 1960s and 70s, the modern world began officially structuring and recognizing it as a banking system.
Now, there are a few core rules governing this massive global system. First, everything has to comply with Sharia law regarding commercial transactions. Beyond the strict ban on interest, true Islamic finance heavily emphasizes asset-backed financing. That means there has to be a real, tangible asset behind the transaction, not just moving paper money around. And most importantly, it requires a genuine sharing of both the financial benefits and the financial misfortunes. To make this super concrete, imagine you want to buy a car using an ideal Islamic loan. Instead of just handing you cash and slapping an interest rate on it, the Islamic bank actually goes out and buys the car first. They take real ownership of the asset. Then they turn around and sell that car to you at a mutually agreed upon markup, and you pay them back in installments. It's totally transforming an interest-based cash loan into a purely trade-based transaction. Pretty clever, right? But the crucial point here is all about risk. Because this is designed as a partnership or a trade, rather than just a guaranteed loan, the bank is actually supposed to absorb risk. In theory, if a business venture fails and makes zero profit, the bank loses out just like the business owner. They are literally in it together. Okay, but does it actually work like that today? Let's pivot to Section 3, the double deception critique. We're going to examine the fierce arguments of financial expert Shabar Zaidi, who has spent 40 years analyzing this system. He argues the modern reality looks very, very different from the noble theory. Take a look at this striking quote from Zaidi. He says, "It is like trying to sell alcohol in a cola container. It is a double deception." That perfectly encapsulates his explosive argument. He claims that modern Islamic banking just takes the exact same conventional interest-based mechanics and simply wraps them up in Sharia-compliant paperwork to appease religious sensibilities. In his view, they're selling the exact same prohibited substance, just slapping a different label on the bottle. And Zaidi's claims present a fascinating, almost paradoxical reversal of expectations. He argues that conventional banking, for all its flaws, is actually more transparent and tightly regulated by central banks. By contrast, he claims Islamic banking hides its profit spreads behind complex rental and trade agreements. And the results? Higher, less transparent costs for the borrower, all completely masked under the guise of religious compliance. Building on that, Zaidi passionately insists there is absolutely no true partnership happening today. He openly challenges anyone, literally anyone, to find a single case where a modern Islamic bank willingly took a financial loss alongside a customer because a venture failed.
If the bank's profit is practically guaranteed regardless of the business's success, critics argue that the entire foundational risk-sharing principle of Sharia is completely defeated.
So, what does this look like for a regular person? Let's dive into Section 4, the housing loan trap, where we'll look at a specific real-world example Zaidi shared from his time as a director at the House Building Finance Corporation. Let's see how a supposedly ethical scheme called Gar Asan, which means easy home, actually turned into a massive trap. First, the bank and the customer agreed to partner on a house, with the customer paying rent to buy out the bank's share. Sounds great, right? But the bank built in a massive loophole. They would arbitrarily revalue the house upward every few years. As the paper value of the house went up, the rent the customer had to pay absolutely skyrocketed, meaning they could never actually catch up and pay down the initial principal. To highlight the sheer absurdity of this, Zaidi discovered a borrower who took out an initial loan of 2 million rupees. Through this constant revaluation loophole, the borrower had already paid an agonizing 3 million rupees entirely in rent. And yet, incredibly, they still owed the full original 2 million rupee principal. No way, right? Zaidi actually had to intervene and reverse these entries to save the borrowers from a lifetime of debt.
Which brings us to Section 5, redefining riba today. Looking at these modern realities, we really have to step back and ask a larger philosophical question. Why is there such a massive disconnect between ancient religious rules and modern financial operations?
Well, to understand this, we've got to talk about the Limited Liability Company, or LLC. This corporate structure fundamentally changed human commerce. And crucially, it's an invention that simply did not exist 1,400 years ago when the rules around riba were first revealed. The historical context here is absolutely vital. Zaidi argues that historical riba was prohibited to stop the total, absolute destruction of vulnerable individuals. Think about it. In the ancient world, if you couldn't pay a debt, you lost your clothes, your bed, your home, you face literal ruin. But today, you have impersonal corporate entities borrowing money to invest, and the personal assets of the individuals are legally protected by limited liability. It is a fundamentally different economic reality. So, from the critic's perspective, interest isn't just a theological problem, it's a systemic reality of how global commerce prices risk and time. Islamic banks are, at the end of the day, commercial entities that require a guaranteed profit to survive. Critics argue that simply wrapping a commercial loan in complex, asset-backed paperwork to make it look like a trade does not actually remove the core economic function of interest. Yet, despite Zaidi's intense criticisms and all these mechanical debates, we've got to acknowledge the reality on the ground. Islamic banking is booming globally. It's drawing in massive institutions and millions upon millions of retail customers. People are desperate for a financial alternative that they feel honors their ethical and religious beliefs, even if the modern execution is frankly imperfect. And that leaves us to ponder a final, really provocative question. Can an ancient moral principle fit perfectly into a ruthless modern corporate system? Is true Sharia compliance actually possible in today's global economy? Or is it destined to remain a compromise, a slightly messy bridge between ancient ideals and modern realities? Keep questioning the systems around you, and thank you so much for joining me on this explainer.